Hello dear traders. At the beginning of the new trading week, market sentiment was mixed after their success seen last week. The fact that global central banks, including the Federal Reserve, are closing in on the end of their rate hiking cycles prevents risky assets from rising. Even Jerome Powell's words that the regulator might undoubtedly raise the key rate in case of necessity failed to affect investors' expectations. However, the downgrading of the U.S. credit rating by Moody's agency and the expectations of important events in the coming days may force investors to remain cautious. The publication of the U.S. Consumer Price Report is the main event of the week. New data may shape the Fed sentiment and affect both markets and the anticipated New Year rally. Stay tuned, the financial market is always rich in unexpected and interesting events. Watch the video till the end and share your opinion in the comments. On Friday, U.S. stock indices increased by 1.2 to 2.1%. The growth could be partially explained by a rise in the tech sector. On Monday, the S&P showed a moderate drop like other key indices. The S&P and the Nasdaq lost 0.3%, while the Dow Jones slid by about 50 points. Traders took a wait-and-see approach ahead of the CPI report. According to the average forecast in the previous month, U.S. inflation slackened to 3.3% on a yearly basis from 3.7% in September. Core inflation remained stable at 4.1% year-over-year. Traders are likely to take a close look at retail sales, industrial production, and producer price figures for the previous month, as well as China's economic report for October. Investors will also focus on the reports issued by the leading U.S. retailers like Walmart, Target, Home Depot, and Ross stores to estimate consumer activity under the existing economic conditions. Tyson Foods, Palo Alto Networks, Cisco Systems, and Applied Materials are also planning to disclose their financial results. Notably, the U.S. government began making formal preparations for a possible federal shutdown, with only several days remaining before current funding expires. Last week, the Dow Jones added 0.6%. The advance could be explained by the fact that traders closed short positions that were opened amid expectations of a correctional process after an 8-day climb early this month. The situation with the New Year rally is still uncertain. Inflation figures may give hints about a future movement in the stock market. If the report confirms a slowdown, buyers are likely to become more active, thus boosting the rally. Otherwise, traders' disappointment may cause a sell-off. By the way, bearish sentiment could be intensified by the news that Moody's agency lowered its outlook on the U.S. credit rating to negative from stable. It's also necessary to take into account the risk of a shutdown. On Friday, the Consumer Sentiment Index, calculated by the University of Michigan, also failed to encourage traders. The indicator unexpectedly shrank to a 6-month low of 60.4 points. At the same time, inflation expectations for the year ahead advanced to 4.4%, with 5-year expected inflation up to 3.2%. Curiously, the market almost ignored the data. However, if inflation figures fail to meet traders' expectations, all the previous reports will be considered negative factors. Although early this month the U.S. stock market increased, this cannot be defined as a prerequisite for a New Year rally. Nevertheless, if in the coming days the S&P consolidates above 4,415, after jumping by 1.1%, the likelihood of a rally will increase. This in turn could signal a rise in the market. Technical levels are playing a key role in the trend formation. However, investors should pay attention to close levels and other aspects that may shape market dynamic. It's necessary to monitor market events. The continuation of the rally will depend on fresh macroeconomic reports from the U.S. and comments provided by Fed Chair Jerome Powell and other officials. At present, one may conclude that the Fed could raise the key rate in December once again in the event of negative data. In general, the market situation looks quite encouraging. Last week, the S&P left the bearish channel and was consolidating near 4,350 for almost all the week. On Friday, it skyrocketed above 4,400 points. The growth we saw at the beginning of November was really impressive. Except for just 2 days, the S&P rose intraday, boosting its capitalization by 6.5%. There were only 10 times when the index showed such a performance. In addition, the company's reports for the recent quarter point to a further rise in the stock market. Current projections suggest a 6% rise in S&P earnings, signaling a much stronger economy than anticipated. As for the Nasdaq, it closed over the previous trading week with a 2% increase. Let us focus on the last important event of November. Thus, Nvidia is expected to publish a report that reflects hype around artificial intelligence, which caused a jump in the market this summer. Other manufacturers of technology hardware and industrial equipment, including Broadcom, Applied Materials, and Arista Networks, will also attract traders' attention. A slowdown in Nvidia's demand may create a lot of difficulties for the companies in the sector. However, if data on orders meets expectations, the new year rally may start. Nevertheless, the week will hardly be calm. The market volatility is likely to be high. Next week, the market could be even more volatile because of the settlement of most issues, including the shutdown possibility. A lot will depend on Nvidia's report. Notably, all predictions concerning the continuation of the trend, which began on November 1st after the Fed's meeting, were made for the period up to the end of the year. A longer-term forecast, which may suggest a recession, will be considered later. And we continue to monitor the stock market situation to keep you abreast of the latest events. Subscribe to our channel and leave comments. We are working for you, making the most relevant video reviews every day and every week. That is all for now. See you later.